in the context of, why it's so great to be here is we're not talking about decline, but in the context of a declining organisation, those investment returns are going to get more and more and more important to keep the church going, and they already make up about 25% of the church's financial income. So this is a serious part of how we keep our church funded and how we keep ourselves moving. The third point here is that we are talking about lots of money. So the Church of England itself has assets of about £12 billion, which sounds a lot. But when you think you've got to pay for all of the pensions and all the upkeep, and actually, like I was saying, the church's turnover is £1 billion every year, that's not a huge amount of money. And also when you talk in terms of investment management, that is a tiny amount of money. It's a huge amount of money for us, but it's a tiny amount of money when you compare to the legal and generals and others who are managing hundreds and hundreds of £1 billion. So we are small, the money really matters to us, and we are significant, but we're mostly significant because of who we are and the fact that the church has the opportunity to say something different. So we can't forget about the financial aspect of it. Now, the slide that's not needed today, climate change is real. It is very sad that I go to presentations and I'm heckled as to whether climate change is happening or not. And the things I always point out to them is that the last 3 decades were sequentially the warmest on record. So the 1980s were the warmest, followed by the 1990s, followed by 2000s. Every decade we are getting warmer. It is happening. And this line taken from the IPCC, this chart taken from the IPCC's report, shows how dramatically that is happening, and people are causing it. We're also seeing the impacts of that. Greenland and Arctic ice sheets are losing mass significantly. Sea levels are going up. So while it's easy to say that climate change is a long-term problem, it is happening now, and we need to address it now. The second point is it's a huge risk. So this is a very hard to read slide, and I'll make sure you get copies of them. But this is a diagram that's taken us from some work that the World Economic Forum do every year. And they go out and look at the world's biggest risks and plot them on the likelihood that they're going to happen and the impact that they're going to have. And you can see kind of pretty near the top there's the green, incidentally the green blobs are all environment and planet related ones. And you can see pretty much near the top as one of the most likely and highest impact is climate change. This is a big risk and one that we have to address. And the next point is they also work out the interconnectedness between these risks, so we can see which ones are causing the problems that we need to solve. And again, you can see failure of climate change mitigation and adaptation at the core of pretty much everything. So extreme weather events, significant risk. The last year was the most expensive hurricane season for insurers ever. We saw 3 unusually large hurricanes come through the US. Extreme weather events are happening. That is due to climate change. Large-scale involuntary migration. We do know, as Ben was saying, that islands and countries are disappearing. That is going to cause migration. We can't treat that separately from climate change. It is entirely connected. So again, going back to that point as to why I think we have to solve this, we solve climate change, we solve a lot of other issues. Everything is entirely connected. That does, of course, mean that we can't solve climate change on its own. We have to look at social factors as well, which I'll come to in a moment. Now, the next slide, again, this is one that I don't need today, but when we start talking to a lot of charity trustees, I start talking to climate change about climate change, and a lot of them actually do look like that. They're mostly quite old men sitting in a room. Obviously, as I'm saying, it threatens our existence. As soon as we start showing the numbers, the economic numbers, all of a sudden they wake up. And we do have to remember that this is an economic consideration. And we've done some modelling. We worked with an organisation called Mercer, who are one of the big investment consultants, to look at what happens if we don't limit temperature rises to at least below 2 degrees above pre-industrial levels. And say the consequences for the market are dramatic. So from a company perspective, we'll see supply chains disappear. As we have those extreme weather events, companies like Unilever, which source goods from all around the world, will no longer be able to do that. If you own property, again, extreme weather events, increased flooding, could well make your kind of commercial property or even houses absolutely financially redundant. So there's going to be a huge impact upon investment markets, and that's something that investors need to wake up to in a way that they haven't already sort of done so. While we're seeing green shoots for investors taking action, we aren't seeing the whole-scale response that we absolutely need to deal with this kind of imperative risk. Now, while I say that it's in our interest to limit temperature rises to 2 degrees above pre-industrial levels, for some industrial sectors that is not good news. And some of you might have come across this new jargon called stranded assets. And stranded assets is the argument that if you buy a BP, a Shell, an Anglo-American, a fossil fuel company, you're not just buying that company like you would at Unilever, you're also buying the assets that it owns. And in the value of a BP or a Shell is the company's profit, but also all of the fossil fuel reserves that it has found and put on its book. Now that's absolutely fine if we were talking about a business as usual world, because if you find something, you dig it, you bring it out of the ground, and you sell it, you're going to get the money back. But we are not talking about a business as usual world. We're talking about a world that will limit temperature rises to 2 degrees. And that means that we don't have the ability to burn all of those fossil fuels. So we've got to start talking about the concept of a budget. Now, so if we are to limit temperature rises to below 2 degrees, I know we need to talk about 1.5 as well, we have a carbon budget of about 886 gross tons of carbon dioxide. That's the amount that we can burn. Now the bad news is, and this is slightly out of date now, through to 2010, we'd already burned 321 of those. So we'd got through a good third, if not half of our budget, leaving about 565 left. Now remember that I talked to you about when you buy a company, you're already buying those reserves. When you look at the balance sheets of these companies, you can see the amount of fossil fuel reserves that are already there. So if you look at the coal, oil and gas reserves, convert those into the equivalent carbon dioxide that would come out if we burnt them, and you get this answer of 2,795. So the big pie chart, big bar on your right. I always get my right and left wrong. I'm facing this way, you're facing that way. But it's definitely your right. That adds up to 2,795. If we bring the budget of 565 in, global policymakers kind of step up and do that. That means that about 2,200 tons of carbon will never be burnt. They are assets that investors already own. It's like taking your £10 note and throwing £9 of it away. You're not going to get the money back. Now, it's not quite that simple, of course. There are different ways that companies are working to make that easier. But the big thing to point out is that coal makes up the majority of that. Coal, as I'm sure many of you are aware, is the most carbon-intensive fossil fuel and the one that we need to get out of the power system as quickly as possible. So when you look at the coal, it already burns out 1,817. We think that's the one that we've got out of the power system the fastest, will be kind of taxed out of business quickest, and the fuel which will strand first. And as a consequence, coal companies, not a financial advisor, but coal companies will be the riskiest over the medium term. That doesn't mean that we can turn our back on oil and gas companies, and we also can't say that oil and gas companies won't be part of the future for at least the short to medium term. So even under the energy projections that we see from the Independent Energy Agency, if we are to limit greenhouse gas, if we are to limit temperature rises to below 2 degrees, fossil fuel use will still peak around 2035. So we've not quite hit peak oil yet. And whilst that's a bad thing, we need to move that forwards, and we need to move that forwards as quickly as we possibly can. We can't forget that these are energy sources that are helping bring the world out of poverty. So we recognise that oil and gas is not finished yet. It needs to be brought to an end as quickly as possible, but we also have to provide energy for the world to alleviate poverty. Now the good news is there is a way for these companies to become compatible with a 2-degree world without wasting your money as shareholders, and that is by slashing their capital expenditure. Basically stop looking for new oil and gas reserves, stop looking for more coal, and the really fortuitous thing is that the oil price dropped significantly in the past 10 years, and as the oil price dropped significantly, fossil fuel companies did what good companies do, which is slash their expenses. And they smashed their expenses to the point where they almost stopped looking for reserves, to the point where they're getting within a 2-degree future. Now this graph is taken from some research that an NGO, Carbon Tracker, did. And what they did was plot that capital expenditure, which is that line here. And they saw that as the oil price went down, expenditure was slashed. And the blue line is basically where we need to be to get to that 2-degree world. And we almost got there. Now the problem is that now the oil price is beginning to recover a little bit, companies are beginning to start talking about business as usual again. And if business as usual happens, CapEx, that exploration for fossil fuels, will bounce straight back up and go back up to that level up there, the business as usual line, which means there's going to be a huge amount of fossil fuels which are either coming onto the market and being burnt, which we can't do. It's bad for everyone, and it's particularly bad for investors as you're increasing the number of those stranded assets. You with me so far? So what we think we have to do as investors, those investors that are investors in these companies, is make sure that they don't do that. We have a huge role to play in talking to the companies about their strategy, explaining to them that about the 2-degree world, how it will happen. People think it won't, but it will happen. Regulation will come in, and stopping them from doing this. So we've got to help the companies make much more informed investment decisions of their own as to where they're going to put their money, and start investing in more renewable technologies, and don't go back to the dig and burn model of the past. And we're seeing green shoots of that. We're seeing BP invest this week in much more kind of green electrical power to support cars. But it's not enough, and it has to move faster. So we think investors have a huge role. We own these companies. We can set their strategies, and we've got to stop them from finding this stuff and bringing it out of the ground as quickly as possible. But of course, as an investor, to be able to have those conversations, you have to be a part owner of the company, which is where divestment isn't necessarily sometimes the most helpful thing, because you have lost your voice, your ability to have that kind of control. So, I'm talking quite confidently about this idea that we will stick temperature rises to 2 degrees. Sadly, we're in the arms of this lady and her fellow politicians around the world, because we absolutely need, if that's to happen, regulation to come in which sets the proper international hurdles to climate change happening. So we need things like a proper carbon price, properly pricing the externalities, the bad stuff that burning carbon has, getting that money back, because if you tax it properly, you won't burn it. It will make petrol completely uneconomic, so we'll have to move to other kind of more efficient ways of travelling. And again, we are beginning to see political consensus for this to emerge, and sometimes in the most strange places. So the US, and I'm going to come to Mr. Trump in a moment and what I think of him. But one of the advantages of Mr. Trump is for the very first time he's created consensus on climate change in the US. Because everyone thinks that his approach is so mad, it's unbelievable. So we are seeing popular consensus to do something, and we're seeing a group of Republicans, people from his supposedly own party, get together to form something called the Council on Climate Leadership, and they are calling for the first time a proper carbon tax in the US. And again, joined by some strange allies like Exxon, who see this as the way forward. So we can't just see fossil fuel companies as bad. Sometimes they do good stuff, although it's quite rare. The next point, we can't show a picture of Theresa May without talking about Brexit. I'm sorry for your international guests. But believe it or not, the UK is actually one of the parts of the leadership coalition in Europe. We are one of the countries that are really pushing for Europe as a relative leader as a continent to take climate change seriously. And when Brexit happens, because sadly it seems like it is going to, we have to make sure that voice doesn't disappear, and that we continue to advocate in Europe, kind of fight against the interests of countries like Poland to make sure that Europe continues to be a leader. And we also can't backslide ourselves, and there has been some very worrying data coming out about slashing of subsidies for renewable energy in the UK and lack of investment. So we can't take our leadership position quite so for granted. Now, you remember I talked about coal as being kind of the enemy of climate action, and politics is the most important way that we can make the changes happen. What I've got here is a graph, a world map, showing where the world's coal-fired power stations are. And the ones in yellow are the coal-fired power stations that are already operating, so you'll see a lot in the West, in the United States. You'll see the UK moving almost totally away from coal power station and then back into the east of Europe, and of course developing countries showing a lot. Now, worryingly, the purple blobs are coal power stations that are in development or planned. So this is going to add a substantial amount of coal power generation to the world, burning that most carbon intensive fossil fuel, increasing the number of emissions, and this is why getting public policy is so important, because we need to stop this from happening. We need to give these countries energy, as I'm going to talk about in a minute, but we need to help them do it in a more carbon intensive way. And when I make the argument in a moment, talking about the obligation upon us in the West as developed countries, we have to move away from this cheap fuel, and there is no excuse really for that correlation between the United States and huge coal power stations. Now finally, some people when I talk to them about public policy say the Paris Agreement solved this for all of us. The world came together, created the Paris Agreement, and we're all sorted now. And the answer is that's not quite the case yet. So what you've got here is some work from the Transition Pathway Initiative, which is something the Church of England national investing bodies have created. And that maps out where companies are on the pathway to limiting temperature rises to below 2 degrees. And my argument was that we needed to make it quite clear that Paris does not get us there yet. So what you've got there is the dotted green line is the temperature, is the emissions cuts as mandated by the Paris Agreement. And then the orange line is the 2 degrees level, and the dark blue line is below 2 degrees. So you can see there's a substantial gap between where Paris is going to get us right now and what we need to do. And the idea behind the Paris Agreement was that every 5 years countries would come back together again, talk about their kind of emissions cut targets, talk about their plans, and ramp them up every single time. So we can't let kind of put the foot off the gas in regards to working with our politicians, because we need much more ambition in 2020 when the world comes back together again. And investors particularly have a huge role to say about this, because politicians do listen to us, and we've got to be making that quite clear. While showing this up, I couldn't pass the opportunity to give the example of a company. So the full green line, kind of the full one, the one that's not dotted, is the carbon emissions trajectory for a UK utilities company, SSE, and what you can see is that they are decarbonising their business and plan to decarbonise their business substantially below the level that we need to do to limit temperature rises. So this is possible. We can deliver electricity, we can deliver power in a way that aligns with limiting temperature rises to below 2 degrees. The theme of this conference is anything is possible. This is possible, we shouldn't think that it isn't. Now, it's easy to talk about the planet and climate change as something that's very different to the way that we live all of our lives. But the fact is that we will only solve climate change if we solve people challenges as well. So if we solve poverty alleviation and the fact that people aren't really buying into this. And we also can't leave people behind. Now I said I'd talk about Mr. Trump. Here's a picture that I grabbed from the internet about some coal miners backing Mr. Trump's work. Trump digs coal apparently, and it's quite clear that he is backing the coal industry. Now, I grew up in Nottinghamshire here in the UK, which is an ex-coal mining area. I grew up in an area that was fundamentally based upon coal. The whole economy was based upon bringing coal out of the ground. I went to a comprehensive school in this area, and I can tell you that the impact of coal mining leaving the area was significant. The economy has still not recovered. And what is going to happen as we go through this transition is that we're going to see huge operations, huge employers no longer able to provide work. So moving away from coal is the right thing to do for climate change, but we're going to leave huge communities with no work anymore and the kind of soul of their community taken out, and therefore we have to take people with us. This is particularly important in South Africa, many of the developing countries that have huge amounts of coal reserves. We can't leave these people behind. So while it's easy to say that this is wrong, that these people are wrong, to talk about coal, to talk about the interests of coal, we can't forget that this is really changing their lives, and there is an onus upon us as investors and as civil society to encourage companies and kind of states to give people the training that they need to find alternative work. Because if we can help these people find alternative work, then they're not going to feel as isolated. We're not going to see the same negative policy kind of pressures coming through to governments to protect the legacy industries, and we can all move forward as civil society together. And I believe that that's very similar to what Archbishop Sharma was saying. We have to solve last night. We have to solve this as an economy issue as a whole. Now, again, we have some remarkably good stats on this, which no one is really talking about. And I do encourage you to talk about kind of green jobs and what's happening. So globally, there are 10.3 million jobs now in renewable energy, substantially rising. And in the US, where these gentlemen are based, 1 in 10 workers now have something green in relation to their job. They're doing one green thing at least every single year and being paid to do it. And we've seen a 25% rise in employment from the solar industry and a 35% rise in employment from the wind industry. So just because these assets are different and don't necessarily have mining doesn't mean that there aren't jobs there, and we have to make that quite clear. This is an economic success story as well as a legacy story. Now, also talking about leaving people behind, we can't forget about the energy challenge. So this is a map that the University of Sheffield created, and they have altered it based on trying to show where the world's poverty absolutely is. So again, it'll be no surprise to you that you're seeing this particularly in Africa and Asia. Those countries which have been blown up significantly are those with the highest levels of poverty. Whereas you come back to Europe and Americas, you will see a lesser poverty. Now, if you pass that on to carbon emissions, you've got exactly the opposite story. So you've got the West pumping out the majority of these carbon emissions, and the countries which need it most, which need the power most, need the cheap power most to try and develop their economies, not getting it. So when the UN talks every 5 years, when they come together about common and differentiated priority responsibilities, we can't forget that we as the West have the responsibility to decarbonise quicker and faster than everyone else. We've already had the benefits of cheap energy in developing our economies. We have to give much more of the budget to the developing world to help them develop as quickly as possible. So we're not all in this together. We have a responsibility to do more. And again, by the end of the century, we absolutely have to get to a carbon neutral world. So finally, divestment versus engagement. This, any excuse to show a picture of Justin Bieber, I guess, in a presentation, but actually this is the front cover of Rolling Stone in 2012, where an article by a gentleman called Bill McKibben started the fossil fuel divestment movement. And this is the fastest moving divestment movement in the history of investment. It's quicker than the apartheid divestment movement. It is really resonating with people. And although, like I said at the start, it's not, I believe, the answer on its own, it is creating significant positive impact. Divestment is happening, and it is making change. Now, the theory behind divestment is, of course, that you take your money away from these companies. I can promise you that is not going to change the share price of companies. Other people will buy the shares and the share price will stay the same. The idea is that fundamentally it stigmatizes them. It makes them look bad, it tarnishes their image, and hopefully stops people from giving them money to lend to create more assets. So it is a very valid way of trying to create the change that we want to see. Whereas engagement, I guess, it is all about working with the companies and trying to create change happening. Now, I think the divestment movement has achieved a ridiculous amount. It has changed the world of investment in regards to climate change. But the one negative thing that it has done is that we've created this false dichotomy between people who think that divestment is the answer and people who think that engagement is the answer, and therefore you aren't necessarily on the same side. And I can tell you, absolutely being at the centre of this with clients who want to divest and clients who want to engage, that they are the same people who are talking about the same thing and want to solve the same challenge. So we have to find this way of finding how divestors can support engagers and engagers can support divestors. We're all on the same side. We have to limit climate change to below 2 degrees. We have to make it happen, and both of these tactics are important. So what we do want to see is absolutely kind of using engagement. If engagement isn't working, making divestment happen, and building upon the momentum of the divestment campaign to talk to companies, and so there's not any more of the people who do that. Because companies are listening to divestors, it has to be said, and therefore they're listening to us as engagers much more than they would have done otherwise. So it's an ecosystem of change. So finally, I fear that I've spoken for far too long. You're probably getting fed up with me. What are we doing with your money? Now, the first point is that we comply and help create the Church of England Ethical Investment Advisory Group policy on climate change. We apply it in letter and in spirit. And if you go right back to that graph I showed about fossil fuels, we think for economic as well as kind of ethical reasons that coal is not necessarily a good place to be. We can't be giving our capital to coal companies anymore. They're far too carbon intensive, and therefore we get out of them. Saying that we go beyond the climate change policy, we take a much tougher definition of what a coal company is than we have to, again, because we think that this is the right thing to do from a financial and a moral perspective. The second thing is like I was saying, we recognise that oil and gas use hasn't peaked yet, and we have a remarkable opportunity as owners, where the companies still look good, to try and make changes happen. So we do hold 2 oil and gas companies. We think there's a whole world out there that there are 2 that we hold, but we're significantly sceptical about their future. So we hold less than a quarter of the amount, which would be a full weighting to oil and gas companies, just because we think their business model is challenged. But that very small holding does allow us to do engagement. And if you are holding these companies, I think what is ethically abhorrent is not engaging with them. So what are we doing? And when we talk about engagement, we absolutely don't want to talk about engagement as being an excuse to hold companies that we shouldn't otherwise do. So some highlights of what we're doing on climate change is that every year we talk to companies in the UK who haven't received a good enough score on the Carbon Disclosure Project's climate change rankings. So looking at the FTSE 350 as a whole, not just oil and gas companies, but any company in the UK that has not received a B grade on the CDP A to D rankings, we're talking to. And that means that last year we talked to, or at the moment as well, we're talking to about 70 FTSE 350, so mid-sized UK companies about climate change. At the end of last year, 31% of those had improved their score on the back of our engagement. Now also, if I'm talking to you about engagement as being a viable alternative to divestment, I have to prove to you that engagement works. So we've been working with the University of Edinburgh, the business school there, to test how effective our engagement is. They looked at some work that we did between 2012 and 2015, and we're kicking this off again now. They broke those 70-odd companies into 2 groups, one group that we engaged with and one group that we didn't engage with, and tested how quickly were they making changes in line with kind of climate change. What we found was that in the group that we engaged with, moved forward much quicker, and the University of Edinburgh was able to say to a 95% confidence rate that the changes that we'd seen were on the back of the engagement work that we'd done. So we have to prove that engagement works, and we have to give you the data to make sure that's happening. Now the second thing is, as church investors, we have a responsibility to go further and farther than the rest of the investment community. And therefore we see it as our role to stick our neck out and make things happen that others wouldn't necessarily see. So if you go back to 2015, we filed shareholder resolutions on the ballot papers of BP, Shell, Anglo-American, Glencore, which I can promise you as a company we will never ever touch, and BHP Billiton and Rio Tinto, asking for them to take more action on climate change, asking for them to disclose to us how their business models stacked up under a 2-degree world, try and get them to start shaping their policies, asking them to talk about what lobbying work they're doing, because we need to stop negative lobbying, and asking them to talk about what R&D they were doing on green technologies. Now, because we kind of talked to the companies and took them along with us, we got their support for those shareholder resolutions, which then meant that they recommended to their shareholders that they vote for them. And for the first time in the UK, we saw shareholder resolutions on climate change that passed. And didn't just pass closely, they got 96% of shareholders voting for them, legally mandating these companies to make those disclosures about what they're doing on climate change. Now, roll forward to now, we're taking the momentum from those engagements, still focusing on shareholder resolutions where they're really needed. Again, a company that we don't and wouldn't invest in, Exxon, benefited quite clearly from the work the Church Commissioners did in getting a shareholder resolution passed last year. But what we're doing is working with the biggest investors in the world through this new initiative called the Climate Action 100+, which is backed by the United Nations Principles for Responsible Investment, and the world's most responsible investors has about $150 trillion of assets under management behind it to get companies to move forward on climate change. And again, because we think that we've got to be at the vanguard of this, we are the world's leading engager on Rio Tinto, so we're not just engaging with Rio Tinto on behalf of the £8 billion that we manage, we're engaging with them on behalf of the $150 trillion of the world's investment sector. That is serious money and can make change happen. So again, we want to be judging the results that we have. Now, I talked about public policy being absolutely key. We also work through an organisation called the Institutional Investors Group in Climate Change, who are lobbyists in Europe and in the UK, who are trying to make that public policy happen, trying to bring in that 2-degree rule, make the next round of nationally determined contributions much closer to the 2-degree line. So engagement absolutely is working, has to be done, but cannot be seen as a reason to invest in companies that we shouldn't, and has to be judged upon what it's achieving, not what are you saying. The next point, the final part of our standard investment approach is that it's all right to talk about divestment and taking your money away, and like I said, that can have a significant impact. you've got to start putting that money to work in different ways. And one of the things that we do believe is there are investment opportunities out there in green technologies, and as a consequence, about 3% of our investment funds are now dedicated to investments that are absolutely changing the world and absolutely bringing about that low carbon transition that we want to see. And they're also making you a substantial amount of money. So one of the things that we've invested in recently is energy efficiency operations in St. Bart's Hospital in London. That's fitted a whole new power generation system, far fewer emissions, giving planet a benefit, but also giving you a benefit because it gives us an 8% investment yield. So a very good investment performer, but also a great technology to try and make the decisions that we want to see happen. So finally, like I said, this is our responsible investment approach. This is what we think is going to make investors the most money and get us to the right place, but we absolutely respect our clients' ethical decisions. And whilst we are going down this line of being very sceptical about fossil fuels, targeted divestments where on the worst fuels and where engagement isn't working, we do recognise that some of our clients want to divest, and we absolutely can do that for them as well. It's just our house approach is to engage, and if engagement doesn't work, then divest, because we've kind of used all of the tools that we have in our armour. I'm going to stop there. There is a risk warning, which I have to encourage you to read. It's basically saying that I'm not an investment manager. This is definitely not a sales pitch in any way, shape or form. And apart from that, everything I said is good. Thank you very much.